Charles, is this one thing that we can trust China on as investors, or what?
I hate to get off to a negative start, but no, absolutely not. In fact, one of the things that we're really calling out is the bubble in Chinese residential real estate, particularly construction of condominiums, which is going to come to a screeching halt. Evergrande and their competitors are just the beginning. There are going to be maybe as much as $100 billion in losses. And so we would expect China's construction activity to drop significantly. And unfortunately, Cat is going to feel that.
Marianne, China's big, as we all know. Do you agree with that? And will this have fallout for more in the industrial sector?
I think there's been a lot of speculation about the Chinese demand falling off ever since the Evergrande revelation. But we think those concerns are overdone, and the company has already reported that orders are up 10%, which can only benefit from GDP growth coming year. And then with moderated costs and share buybacks, the company should be able to reach the high end of the EPS growth estimates, or about 30%, since the shares are trading around their 10-year average on an EV to EBITDA basis. We would expect to see some expansion in that valuation also.
Bob Bazzani, not going to ask you to be a tiebreaker here, but do you have any insight into whether investors are largely pricing in one way or the other problems in China when it comes to construction and real estate, or not?
Sure. Absolutely they are. Look what happened to Caterpillar. It just dropped in the middle of the year as concerns about China came to the fore. But China's probably only 20% of their revenues. I would focus a little bit more on, for example, the North American construction cycle, which is going to be pretty strong still. I think it seems to me it's going to be very strong. The other important thing is just focusing on the supply chain. A lot depends on how you feel about inflation. So, for example, probably 15% of Caterpillar's costs are steel costs. They went way up this year. The hope is that the steel cost is going to come way down. That would help their cost of goods sold, of course, rather dramatically. So a lot of this depends on where do you come down on the cycle. We seem to be in a mid-cycle, although it's pretty confusing. Mid-cycle industrial names generally do pretty well in mid-cycles. We seem to be in an upswing still in construction in North America. That would benefit. I guess the overall question is, where are you on the supply chain issues? And hopefully they'll mitigate a little bit in 2022.
All right, investors will place their bets. Next up, Darden Restaurants higher today on an upgrade to buy from hold at Stifel. Shares are still lower by about 2% over the past week after the Olive Garden parent company announced in its earnings release longtime CEO Gene Lee will step down next year. But in that same report, Darden beat on the top and bottom lines and posted better than expected comps. Stifel attributes the drop in shares to Lee's retirement, but says it's confident in his successor, who's currently Darden's CFO, that he can keep the company on a similar growth path. Marianne, so what do you think? Lots of breadsticks in 2022 or no? How's this going to work out for him?
Well, no breadsticks for me, but Gene Lee has a great track record at Darden, and prior to that, a great pedigree at Rare Hospitality, which Darden acquired. So as it's been for decades, we believe Darden has a very extensive bench of talent. And Gene's absence starting next May, it's not like it's tomorrow or anything, that does not undermine our positive outlook for the company. And look to today's consumer confidence report from the Conference Board. It shows how rising employment is increasing people's appetite for eating away from home in the coming year. I mean, that's my read through. But we believe that Darden will continue to grow, continue to take market share. The stock should increase in line with earnings per share growth, which looks to be in the 22% area for calendar 22.
Bob, a lot of Darden, there's a lot of carbs in there. I mean, is that okay? I don't know. Like sustainability, we're generally talking about the planet, not individually our waistlines. But how's that trending with investors treating restaurant names like that?
It's trending really badly with me. I can tell you my carb intake has gone up. So bad question to ask me. Look, how'd you like to project Darden's revenues for the next 3 to 6 months. It depends on where you are on Omicron. I mean, if you believe that people are going to power through this and still go out, then this company is very well positioned. Darden has been growing their earnings along with their revenues for years. They trade at a very reasonable multiple. It's about 17 times 2022 numbers. That's excellent. That's right in the middle where it's been for years. They're not overpriced. They're very fairly valued. Some would argue, as they are here, that it's actually undervalued. So on a valuation basis, I don't have any problems at all. The problem I have is what side of the debate on Omicron are you on? If you're pessimistic, you're going to think there's going to be an awful lot of cancellations in the next few months. That's the problem I have, not on valuation.
Well, then, Charles, do you have to look closely at their omni-channel strategy and see whether they can thrive despite that? Do you bet on Americans eating the way we've always tended to?
Look, this is a crowded trade. If you look at Wall Street, they have one of the most lopsided buy ratings of any restaurant. If you have, say, a buy is a 1, a hold is a 2, and a sell is a 3, this has an average rating of 1.3, which means overwhelming buy side from recommendations from the street. It's trading at 14 times EV to EBITDA. So I unfortunately disagree. I think this is an expensive stock that everybody loves, and they're going to suffer from higher wages. Labor costs are a big part of their cost structure, and it's going to be a tough year from a margin point of view. So I think this is, at best, a hold.
Oh, sounds like you're saying investors would get indigestion from this bottomless buy rating. All right. Loop Capital Markets up next, upgrading Williams-Sonoma to buy from hold, saying it remains America's premier omni-channel retailer. The firm says the pandemic remains a tailwind for its housewares into the new year as the home improvement boom rolls on. Loop also cites robust free cash flow, 70% e-commerce penetration as reasons to be bullish. Loop says the stock has had an 11% pullback this month, and that created an attractive entry point for investors. Sees more than 20% upside from these levels. Bob, I guess this, in a way, is the flip side of the Darden trade, right? You don't go to Olive Garden. You stay at home and make stuff with your expensive cookware. Is that a better bet?
Yeah, no, that's exactly right, John. I mean, somebody's wrong here. This is the opposite of the Darden story. This is the ultimate work from home story that's out there. I think, and again, this is where do you come down on the Omicron story? If you believe people are going to stay at home more, cancel their reservations, and not go to work as much, it's a great company. It's also a great company on a valuation basis. I mean, this is just one of the great winners on Wall Street. I'll tell you what I love about this. They're in one of the top maybe 15 buyback monsters out there. This company has aggressively bought back stock and, unlike many companies, have actually reduced the share count. Their share count's down about 25% in the last decade or so. That's significant. That means everything else equal, earnings are 25% better than they were 10 years ago because of that. And it's pretty reasonable. It's about 12 or 13 times 2022 earnings estimates. That's not bad at all. So again, on a valuation basis, I don't have any complaints at all. I just want to know if the work from home story still has resonance in 2022.
Charles, what's interesting to me about this is the omni-channel play, right, that they've done pretty well there. And then also the idea that it's a tool that's also sculpture. It's like you leave these things out in the kitchen. So maybe the home improvement trend, not just the eat at home trend, almost maybe like an Apple of kitchenwares. Is that fair?
Oh, I think it's absolutely fair. And you don't have to have a stay-home structure here. People are buying new houses. They tend to stock those new houses with Williams-Sonoma goods. And it is trading at 8 times EV to EBITDA as opposed to our previous name at 14. So this is a great company that's gotten really rocked in the last month for, in my opinion, no good reason. A great company trading at a very attractive valuation.
All right. And speaking of money, finally, Oppenheimer naming Coinbase a top pick for 2022, saying the exchange is poised to benefit from expanding digital asset adoption, as well as the rise of DeFi, that's decentralized finance. It's been a roller coaster for shares since Coin went public in April. They're higher today, but down nearly 20% in December, on pace for their worst month since May. Marianne, is 2022 going to look better for crypto and Coinbase?
You know, not if you look at the charts for Coin or Bitcoin. And there's over 12,000 cryptocurrencies out there that are fighting for market share. We continue to lack an understanding of cryptos in favor of gold for a high inflationary environment that we find ourselves in. And so this space remains Vegas money for our clients and not part of our models.